Imagine buying a stock that doubles your money in just 5 months only to watch it wipe out over $1 trillion in a single afternoon. That is exactly what just happened in the semiconductor market. Most people think chip stocks are a guaranteed win because artificial intelligence is growing so fast. But the terrifying truth is that some of these companies are trading at prices that assume they will control the entire world by next week. Today, we are breaking down the absolute numbers to see if you are walking into a trap. What most people do not know is that a massive hidden shift in how tech giants spend their money is creating a dangerous bubble. To understand if these stocks are truly overvalued, we have to look at how they make money. Right now, companies like Microsoft, Google, and Amazon are building massive data centers. They are buying millions of chips to power AI models. This has caused chip company profits to skyrocket to levels we have never seen before. But here is the catch for everyday investors. Stock prices usually move based on future expectations, not just what is happening today. Investors use a basic metric called the price-to-earnings ratio to judge a stock. It compares the current stock price to how much profit the company actually makes. Historically, a safe and normal ratio for a stable tech company is around 20. Today, many semiconductor stocks are trading at ratios well over 70. That means you are paying $70 today for every single dollar of profit the company might make next year. Before you skip to the end to find the list, you need to understand why this matters right now. This extreme valuation is high as long as profits keep doubling every few months. But if growth slows down even a little bit, the stock price can fall off a cliff. Think of it like a game of musical chairs where the chairs cost $1 million each. The music is still playing, but the room is getting incredibly crowded. The surprising part comes next when we look at the buyers of these chips. Big tech companies plan to spend an astronomical $700 billion on AI infrastructure this year. That sounds amazing for chip makers. However, those tech giants are not making massive profits from AI software yet. OpenAI is reported to be losing billions of dollars just to run its models. If tech giants realize they are spending hundreds of billions on chips without getting a return, they will cut their budgets. The moment Microsoft or Google reduces chip orders by even 10%, semiconductor revenues will plummet. Because stock prices are priced for absolute perfection, any tiny dip in orders will cause a massive panic. If you are finding this breakdown useful for your portfolio, make sure to hit that subscribe button right now so you never miss our daily market alerts. Let us look closely at 10 specific semiconductor stocks that have reached dangerously high valuations. First on the list is Marvell Technology. It makes custom chips and optical connections for massive data centers. The stock has surged nearly 200% this year alone. It is currently trading at a staggering 74 times its forward earnings. The danger here is that their biggest tech customers are starting to build their own custom chips internally. If those customers walk away, Marvell's stock could face a brutal correction. Next up is ARM Holdings, famous for designing the architecture used in almost all smartphone chips. ARM does not even build the physical chips, they just license the designs. Investors have pushed ARM's valuation to extreme levels, expecting it to dominate the AI PC market. But competitors are already moving into their territory with cheaper alternatives. When a stock is priced for a total monopoly, even a tiny bit of competition destroys the thesis. Our third stock is Advanced Micro Devices, widely known as AMD. AMD is a fantastic company that makes powerful computer processors. But its stock price has soared because investors view it as the main challenger to NVIDIA. The problem is that NVIDIA still controls over 90% of the AI chip market. AMD's current valuation assumes it will steal massive market share very quickly. If NVIDIA maintains its lead, AMD stock will likely head much further down. What most people do not realize about the chip industry is that it relies on massive machines to print the circuits. This brings us to our fourth stock, ASML. They build the extreme ultraviolet lithography machines needed for advanced chips. ASML has a complete monopoly on this technology. However, the stock is currently trading at a massive premium price-to-sales ratio of over 15. Because these machines cost hundreds of millions each, ASML's revenue depends entirely on chip factories expanding. If chip factories slow down their expansion due to oversupply, ASML's massive backlog will dry up fast. Fifth on our list is Lam Research, a company that provides equipment to etch patterns onto silicon wafers. The stock jumped over 100% recently due to the sudden rush for new equipment. But chip equipment manufacturing is historically a highly cyclical business. This means it goes through massive booms followed by deep busts. Right now, we are at the absolute peak of the buying cycle. Buying at the peak means you risk holding the bag when the cycle turns down. The sixth stock is Applied Materials, another giant in semiconductor manufacturing equipment. Just like Lam Research, its valuation has expanded dramatically based on short-term demand. What investors are ignoring is that global smartphone and PC shipments have actually been contracting. The only thing saving them is AI data center demand. If that single pillar wobbles, the traditional consumer chip decline will drag the stock down aggressively. The surprising part comes next when we look at the memory chip makers. Micron Technology is our seventh stock. Micron makes the high bandwidth memory chips essential for AI servers. Its stock has skyrocketed by over 200%. While their current margins look incredible, memory has always been a commodity market. When there is a shortage, prices double and everyone makes money. But memory companies always end up building too many factories. This creates a massive oversupply, crashes chip prices, and destroys stock valuations almost overnight. Eighth is Qualcomm, the king of mobile smartphone processors. Qualcomm is trying hard to rebrand itself as an AI company for cars and laptops. Investors have bid up the stock based on this new narrative, but their core revenue still comes from smartphones. Even worse, their largest customer, Apple, is actively developing its own internal modems to replace Qualcomm chips. Losing Apple's revenue while mobile markets are slow is a recipe for a downward stock trend. Our ninth overvalued stock is Broadcom. Broadcom makes custom networking chips that connect thousands of AI processors together. The stock recently joined the top 10 largest companies in the US market. It has grown mostly through massive corporate acquisitions. This strategy works well during a bull market when debt is easy to manage. However, if the integration of these massive companies hits a snag, or if networking demand cools, their heavy debt load will crush their margins. Finally, 10th on our list is Intel. You might think Intel is cheap because it struggled in recent years. But Intel is trading at a price-to-sales ratio of over 11 while showing almost zero revenue growth. They are spending hundreds of billions of dollars to build new chip factories from scratch. This massive spending means they will have negative cash flow for a long time. If their new manufacturing technology fails to win over external customers, the stock will fall much further. Make sure to subscribe and look out for our daily videos breaking down the stock market.